Of course, this is not financial advice and for entertainment purposes only.
Investors, welcome a very special guest, Mr. David Nicholas from X Funds, the portfolio manager of X Funds and the portfolio manager of BLOX ETF as well, which is the Nicholas Crypto Income ETF, where this ETF provides exposure to both Bitcoin as well as Ethereum, as well as crypto industry companies, and provides weekly income as well. So I'm going to throw it back to you, David, on how you're feeling about being on the channel and the launch of BLOX and all the success lately.
Yeah, Marcus, great to be here. You have a great channel. I've watched a lot of your videos, so it's really an honor to be on. So I appreciate you having me. And no, we're just excited overall. I think being in crypto in the last month and a half has been, I think, just a really great asset class to be invested in. So obviously the fund has exposure to it. So really excited to talk with you about it.
What made you launch X Funds as well as BLOX ETF, and why are you so excited about BLOX?
Yeah, so this is my 20th year now as an investment manager. So it's been an interesting career, but during COVID, obviously COVID was a very unique time for investors. So many of us that were investing through COVID, it was one of those almost like once in a lifetime uncertainty just that we were dealing with. And so really as a fixed income manager, interest rates really impact a lot of different things. Obviously fixed income, but they can impact equities and valuations and multiples. So if you remember, rates really hit rock bottom, right? We had treasury rates that were close to zero. And then all of a sudden we're in this low rate environment, which we had been. Rates started to come back up. Clients at our private wealth firm were asking about treasuries. I mean, I haven't been asked about treasuries in 15 years of being an advisor, but all of a sudden we had overwhelming amounts of clients ask for treasuries. And so our first fund was FIX, Treasury Fixed Income Fund. That was really built as a way to give our clients access to treasuries with the goal of getting a little additional yield by using an options overlay. And so if you remember, or if you know how annuities work, a lot of insurance companies, these are big, large insurers, they buy fixed income and then they generally are doing long call options or doing call spreads to generate higher yield over above the fixed income. And I said, really no one had done that before in a ETF wrapper. So I said, how about we just do what the insurance company's doing, but try to offer it in an ETF wrapper. So that started FIX. And then I couldn't just do one ETF and stop. So I was like, if we're going to do this, let's really put some resources behind it, which is why, we've launched 2 other funds since then.
Now, can you also go over the investment objective of BLOX as well as the holdings and what this ETF aims to provide investors?
Yeah, that's right. So the investment objective of BLOX, which is a little different from a lot of other income funds, is primary objective is capital appreciation. I think this is one of the unique distinctions of a fund like BLOX is that a lot of great income funds out there, a lot of great competitors, but they drive income being the primary goal. And so with BLOX, I wanted to do something a little bit different because for me, if you're a crypto investor, sure, you might want an income, and a lot of us want income and we want it as soon as we can get it. But for me, crypto is a space that I want to be able to participate in the long-term appreciation of the space. Let's just say I have a sizable position that I want to put to work. Am I really going to be comfortable of putting in a sizable position into a fund that I could wake up a year from now and is down 50 to 60% due to NAV decline? Now, total return, I may be up, but I wanted to take the opposite approach. I said, well, why don't we give investors income, which is we know many income investors want, but why don't we give them the ability to confidently be able to invest? Obviously, no promise of the future. Confidently be able to invest, get your income, but also see some NAV appreciation. And so it's really how the fund is structured, where we actually are doing something unique. I don't think any other fund is doing this. We are doing call spreads on the crypto side of the portfolio. So the crypto sleeve, which is currently Bitcoin and Ethereum. We use HODL, we use FBTC, we use ETHA for Ethereum, our Ether exposure. So we sell call spreads there, which does cap a part of the upside, but then the long call gives us unlimited upside participation in it. But on the equity side, and this is where I think is so unique, we're selling put spreads. Now we can change that at any time, but doing that has definitely paid off over the last 2 months. And you can just see that with the price of these underlying positions going higher. By selling a put spread, not only do you get all of the upside of the underlying positions, you also get to harvest the income from the volatility as well. So to me, it's almost a best of both worlds where, and again, the way that I looked at it is where if we believe in the future of crypto and we believe in the whole universe of crypto, that there's true upside potential here, why would I want to cap that? You almost will always underperform the underlying holding by selling calls or even call spreads. The only way to get around that is by selling put spreads. And so for us, we get unlimited upside on our underlying positions, and we get all of the income that the spreads will generate because we're not capping our upside.
I was going to ask you, like, why is the primary objective capital appreciation and then the secondary objective current income? But from what I'm hearing, it's like you don't like seeing like NAV decline, NAV erosion. You like seeing like total returns as well as upside potential, because one of the zonks of a cover call ETF, and this one is very unique, is that you get that limited upside and then you're going to see that your chart just look all red and be negative, but then you have to factor in the total returns. So I think that's one thing that investors like about blocks, and what I like as well is the upside appreciation. You guys care about the NAV, and since inception, blocks has only gone up, and if you factor in income as well, it's gone up even more.
You really got to think about, as an investor, what are you trying to achieve? I know there are some investors out there that are living off of 100% of the distribution from these funds, but I actually think that's a rarer scenario. What I typically see is you've got investors that they have a position in an income fund, they get their distribution and they drip right back into the fund. And so again, I understand that. But so if you're dripping back into the fund, at the end of the day, yes, you're paying down margin. Then really the metric that matters is total return. So whether I'm giving you back some capital appreciation or income, and then you're buying back into the fund, or I'm just letting that stay in the fund and let the managers do the work of allocating that capital, to me, it's total return. And so I'm so excited to see the success of the fund so far. Obviously, it's no guarantee of the future. But for me, when I look at total return, I want to see a fund like Blocks outperforming the competition because we're being strategic in the way that we're doing our options positions, but we're also being smart, looking at the fund in a way, where's the best way to allocate capital, being intentional on how we're reinvesting and redeploying that capital from our income.
Put spreads versus call spreads. So that's very unique about Blocks. I'm also thinking that maybe you guys are earning more than you guys are giving out to investors. What is the reason behind that? I'm sure it's for the NAV and probably reinvesting some of the earnings back into other positions. So I'm going to throw it back to you on why maybe you guys don't give out all the income to investors and the benefits of that.
Yeah, so there's actually quite a bit of implied volatility on a lot of these crypto names. And so we really, if we wanted to, we could probably juice the yield of Blocks up to 80, 90% if we wanted to. But again, and that may get a lot of AUM into the fund even quicker than what we've grown it now. So you have to understand, as a fund manager, there's an economics decision here. Probably the best way to grow fund assets would be to heighten up the yield as much as possible. I fought that, and I'm fighting that for the good of our shareholders and our investors, because I ultimately feel by not doing that, we're going to provide more total return for investors. But it's hard when you're comparing two funds, right? Hey, this fund is 80% distribution yield. Your fund is 36. Well, I'm going to go with the 80% distribution yield. And I would say, I think we can get there and outperformance potentially by just the total return. And then you can decide, what you want to do with that gain. But what you asked was a great question. So our goal of every options position that we put on is to get an annualized yield of about 50%. And so that's where we're putting our strikes. And that also tells us how far to the money do we need to go. Generally, we're going to go at the money. Our protective put or our long put is how far out that spread is going to be determined based on that 50% annualized goal. Because again, part of it is we're not going to be right on every trade, right? In the last month, I would say the last 3 weeks, we've had a lot of these positions like Bitmine, Robinhood, Coinbase, they've all come down in price. With that, right, we're not going to be profitable in every single one of these put spreads, but we think if we can aim for 50, push out 36% yield, we really should not be using capital in many cases to pay this distribution.
So I noticed that you guys have put spreads or protective puts. Is that correct? And I want to know more about why you guys have that in place and the importance of protective puts, because so many other funds in this space also have protective puts. And I think that's super unique about Blocks having protective puts, the upside potential, weekly income, and just everything. I'm almost blown away about Blocks right now.
Yeah, no. So let's take it. Most people know selling covered calls. So if you just look at a traditional covered call strategy, you're going to sell a covered call either at the money or out of the money. Depending how far out of the money you go, depends on how much income you can generate. But remember, if you're selling, let's just say you sell an at the money call, right? What you're going to get all that income, but you're not going to participate in any of the upside participation. So you're not losing, but you're giving up on any gain that you would have got of the stock minus what you got in income. Okay. So you're capping your upside. On a put spread, it's just the opposite, right? If I'm selling, let's just say I'm just selling a put, right? So I'm not buying the protected put or not doing a spread. So if I'm selling the put and the stock goes up, great. I'm getting the appreciation. I'm getting the income. But if the stock declines in value, if I sell an at the money put, the underlying declines in value, I'm losing on the underlying, but now I'm also losing on the spread that I sold. So it's almost like a leveraged loss. Right. And so what we do to protect against that is we do the spread. So we sell our put maybe at the money or a little out of the money, and then we're going to go and buy another put below it. And so that way, if the stock continues to drop, we've limited our loss on that. We didn't limit our loss on the underlying position. We've limited our loss on that spread. And so to me, it's a way that we're not going to have a leveraged outside loss by doing this, because we can get a lot more premium just selling a put, just like we can get a lot more premium by just selling a call. But that's going to come with its own risk, either giving up upside or really generating additional downside because of that exposure. So that's the spread strategy. But we have a wide mandate in the prospectus. We could just do straight up protective puts if we wanted to. So probably could have done that a few weeks back, given some of these stocks hit all-time highs. But if we wanted to, we could just go a true protective put. We may sell a call, generate some income from our call and buy a protective put to pay for that insurance. And that is a way that we hedge the downside risk to the portfolio.
What type of investor is BLOX for?
Yeah, so I think this is obviously BLOX is for investors that believe in the upside of crypto, because it's not just if you believe in the upside of Bitcoin, it's if you believe in the upside of the crypto universe as a whole. And so we took the approach of, I don't just want to own the locomotives. I want to own the company that's putting the tracks down. I want to own the company that's the coal. I want to own the company that's all around that universe, right? Just kind of the Warren Buffett model. The type of investor for BLOX is really just someone that you've got generally a higher risk tolerance. If you look at the standard deviation of some of our positions in the portfolio, especially some of the miners, especially some of the treasury companies, these are high standard deviation positions. But if we're option sellers, that's good. You actually want some standard deviation of those underlying businesses because it allows us to generate higher income. So risk tolerance wise, I would say you're an aggressive investor that believes in the long-term growth of crypto, but you also want a broad-based approach, and you're not just relying on the price of Bitcoin or Ether. I've said this a few times. The more that Bitcoin becomes more of a household name, we would expect the standard deviation of Bitcoin to come down. So if you're in a Bitcoin only income fund, for example, and there's some great ones out there, but I highly doubt they're going to be able to keep the same distribution rates as Bitcoin becomes more of a household name and the volatility comes down. But what we can do in BLOX is we can go find those high vol names that we don't buy them just because they're high vol. We believe in the upside of the name and the story so that you can harness that volatility and pair it with maybe the stability. It's hard to say Bitcoin's stable, but I think it is getting to a place where it's more of a stable asset relative to some of those higher vol equity names.
Why do you provide exposure to Ethereum plus crypto-related companies? Because so many other cover call funds provide exposure to Bitcoin or only to Strategy, and that's their flagship fund. But BLOX has like pretty much Strategy and Bitcoin and Ethereum and all these crypto-related companies. So I think it's super unique.
Yeah, so obviously Ether is the native cryptocurrency of the Ethereum network. Was GFL to just look at relative returns. So as an investor, you look at Bitcoin, you look at Ether. Ether had lagged really quite significantly relative to Bitcoin. And so it's the same thing that we would evaluate two stocks in the same industry and they're priced both at different valuations. We would say, hey, from a relative return standpoint, position A is a much better buy over position B. That when we launched the fund, we looked at Ether and said, you know what, from a relative return standpoint, we think there's more upside in Ether. Now, well, David, why don't you go 40% Ether, 10% Bitcoin? You still have to give the market what it wants. And it's funny, even when we launched the fund, we had people on X saying, I love it, but there's Ether in it, so I don't want it. I can't believe you put Ether in the fund. I don't want Ether. And that's a very real thing. And so I said, look, let's lead with Bitcoin, but we need to have some Ether exposure in the fund because from a relative, and I think we were right. I think Ether, I don't have it exactly. I think Ether was up 50% plus, I believe, since we launched the fund or prior to. So we got that right. It would have been nice to have a little bit more exposure to it, but that's why we felt, just given the two, I would say, most popular cryptocurrencies at the time, Bitcoin and now Ether, that we wanted to have that exposure.
So you guys are targeting a 50% distribution yield. What is the current rate right now?
Yeah, so the current distribution rate on the fund is 36%. It's a lot easier to hit that 50% distribution yield on our equity positions. On the Bitcoin positions, we got to be more creative. And so, just for our listeners to know, our spreads are going to be a little bit wider on the Bitcoin and Ether side of the portfolio. And that's mainly to try to get that 50% yield. And so here, what are some of the negatives? If Bitcoin runs up, our spreads are normally 4 to 5% wide. And we are normally going to put these out a week and a half. There's a scenario, and we have actually seen this in some weeks, where Ether ran up 4% in a day. So we may not have captured, we got all the income that we got 4%, and then it runs up 4% in a day. So we may not have got that appreciation, but now because we're buying the long call, anything above that, we're going to get the appreciation. This is why I think it's really great about this fund as well, as the fund is not relying on Bitcoin and Ether to go up in price, because we're almost harnessing as much volatility as we can off the Bitcoin and Ether, and we're letting the equities do a lot of the upside growth, really the heavy work. But we got to have exposure there. And so I think that it's unique in that we're going to get, I think, a higher long-term cap appreciation, mainly because the equity's driving it. And look, if Bitcoin and Ether do it, great, but it's really not dependent on that.
Why does BLOX pay weekly and not monthly?
We filed the prospectus with it being monthly. I don't normally do this. With me and my wife's 10-year wedding anniversary. We were in Europe. I'm pretty active on X. And I was like, you know what? Let me just poll. We had already filed the prospectus, but I was like, let me just poll some of our X friends and see, what do people want? Because again, this is a fund for you as investors. I was actually pretty against weekly distributions because there's some math that we will lag a little bit, but doing weekly over monthly, we really haven't seen that much just because the fund performance has done so well. But I was like, I'm against it, but let me just poll. And we had overwhelming response. David, weekly. I even emailed some friends that are YouTubers as well. Their response was weekly. And so we said, you know what? If we can do it in a way where it really doesn't give up a lot of performance, I'm open to it. So I talked with the options team, and we basically were like, yeah, we can generate enough cash each week to be able to make weekly distributions. So we did a sticker amendment to the prospectus, got it switched over to weekly before the launch. So for me, it was important. And I actually really, now that we've had it, our thing is, why wait until Friday to get paid? If I can get paid every Monday, and then if you think about it as a shareholder, you now have this influx of cash on Monday. You can then diversify into other funds if you want. You've got the whole trading week ahead of you. You can buy back into BLOX. You can use it for income. It's really just a lot. So I think in the future, we probably will launch more and do more on a Monday, because I really like the way the structure of that is.
How has Tidal been super hands-on with handling BLOX? Because I know that Tidal helps with maybe the option strategy or success of BLOX kind of become a thing.
I know you know Jay Petrocelli. I know he's been on the channel quite a few times. I've known Jay for almost 15 years. Jay single-handedly is the reason why our funds are at Tidal. And so, when I was sharing my ideas with Jay, there's a lot of other ETF providers, but Tidal is, I think, the best when it comes to the options trading team. And, Jay kind of really brought a lot of his expertise. Jay's ran a very successful options house that we've used for our private wealth clients. He ran the trading floor at TD Ameritrade. So Jay really brought a lot of that expertise to Tidal. So for us as an options fund manager, they're back. I think they have 40 traders now on their trading team. So for us, it was a no-brainer that we are going to have options funds. We might as well go with Tidal given their expertise. And so they've been fantastic. They've been great. Again, we come up with strategy, they execute it. So it's just a really good relationship.
I've noticed that the distributions every single week for BLOX have been super consistent and stable. So my question is, how are you guys able to achieve this super stable distribution, even if the underlying holdings are super volatile and other funds that are Bitcoin related or strategy related are super volatile?
Yeah, so we have a fixed number right now at 36%. Is our goal is to kick out 36%. Now, we can increase that at any time, we can lower it at any time. But you're right, if you look at the steady increase of the distribution per share, we start the fund open at $20 a share. We've hit as high as I think, over $23 a share of a share price. So if you were one of those early investors, right, your 36% yield started at $20. But as the share price has grown, it's 36% of the current share price. So the idea is that we're distributing more from a percentage standpoint based on $20 per share. But ultimately, because the NAV has grown, that's also meant that we have to pay out more, right? And so that's a good thing to investors. But yeah, the goal is to keep it steady. Some funds, they will change the weekly distribution or monthly distribution based on the amount of options income that they're generating. We've just said, hey, let's let the averages play out. We're going to stick to a set rate. We can change it, but then we'll behind the scenes, dollar cost average, buy back in to try to maintain that 36 distribution going forward.
When you hear the term diversification, do you believe that BLOX has a portfolio that is diversified amongst crypto and just the whole industry as a whole?
Yeah, it does. So if you look at the way that the underlying holdings are, and I'm just pulling, so Robinhood, for example, our two main custodians are Robinhood and Coinbase. So that kind of covers for us from a custodian standpoint. You've got the chip makers, which are NVIDIA, TSM. You've got some of the miners like Riot. You've got Mara that's started as a miner, but now they are a little bit of a treasury company as well. BMNR, which obviously is Bitmine that has exposure to Ethereum treasury company. MicroStrategy, Bitcoin treasury company. XYZ, you've got Block. So again, Hut 8, there's been a lot of, I would say, disappointment with some of the miners. And so we saw that, right? Like names like Riot, they got beat up pretty bad. Names like Mara. But again, like I was looking at Mara the other day. Maybe they're valued around $5.5 billion last time we checked. Just the amount of Bitcoin that they have on their balance sheet. I think their balance sheet is valued. I mean, depending on the price, it's probably down, but the Bitcoin on their balance sheet is valued at more than what their market cap is. And then that doesn't even bring in all the revenue, right? So if I just look at just what their revenue was, it's pretty significant. I think over 800 million annualized. So to me, a name like Mara is a no-brainer. You've got just the book value of the company just based on the balance sheet of Bitcoin. And then you've got the revenue from the mining as well. So to me, a name like Mara makes a lot of sense. But again, we're going to find names, and we've been, early on some names. We've been a little late on some names. But if there's names in the crypto space that are new that we have upside potential and that we feel that it's there, we've been looking at Irene as a ticker symbol. There's a few more that we're looking at that will probably make changes. And we want to be active. I'm a big believer in holding stocks forever if possible, but in the crypto world, I think it benefits from being a little active just because of the volatility in the underlying.
It sounds to me that BLOX is more of like a long-term hold. So do you believe that BLOX is a long-term investment for investors?
I really do. I think BLOX is one of those names where you can buy it and forget it. Don't forget about it, but forget it in that, to me, this is a name, like I'll just full disclosure. I mean, a lot of my personal investment net worth is in BLOX. And we've had other funds before, great funds like GIX that I'm invested in all of our funds. But if your risk tolerance is appropriate, I think BLOX, the upside is there. And mainly just because, especially if you're, whether you're in retirement or you're a younger investor, when you're not capping your upside growth. So if you can generate income, right, 36% yield, but then give you full exposure to these names like NVIDIA, Taiwan 70, Coinbase, Robinhood, Circle, I mean, some of the other names that have really upside, Gemini, that have upside potential. To me, this is a long-term play. Analysts, and even myself, that believe Bitcoin could see its next big leg up, right? We see Bitcoin above 200,000. What does it do for the revenue of some of these companies? You start getting Bitcoin prices to 400,000, 500,000 into the future. All of these companies that benefit from Bitcoin, it's like a leveraged play on Bitcoin. If you go back to our launch date, which is on June 17th. So if you take June 17th for now, if you just take IBIT, IBIT is up around 7% over that time period. We had a little bit of a sell-off last week towards the end of the week. BLOX is up just about 20% since then. So BLOX has performed 3 times the return of Bitcoin. There's no guarantee that can continue, but if you just look at it from the initial launch till now, this is about a 3x Bitcoin exposure without having the leverage of a 2x or 3x fund. You're getting the leverage by buying and owning the underlying positions that are in that crypto universe. And that was my whole intent of this fund, is that I believe these companies will actually provide us more lift because they have real earnings, real revenue growth. But if you balance those two together, you can have, and if you're bullish on crypto, I think you could significantly outperform the price of Bitcoin long term. Going back to what I just said, right? Bitcoin hits 200, 300, 500, hits 1 million over the next decade. What does that mean for those underlying positions? And I think we get a very nice leveraged appreciation on the price of Bitcoin.
I've noticed that the distributions are categorized as return of capital, like what is ROC and what is return of capital when somebody gets the weekly distribution from BLOX.
We'll talk through return on capital a little bit. There's been some misunderstanding here of, hey, well, David, I'm not really earning anything. You're just sending us back our capital as a distribution. So this really has to do with just the way the options contracts are done inside the fund. And again, we have tax experts, CPAs here at the firm. I'm probably not the best tax fund expert, but essentially when the way that the options contracts are structured, because we're doing a spread strategy inside the portfolio, a lot of that is very tax efficient, meaning if our long call is making money, but our short call is losing money, that nets each other out. And so when we're distributing that distribution to clients, it's coming back as a return of capital. And so it doesn't mean that we're not making anything or that you're not profitable. It just means that the way the options businesses are structured, the IRS looks at that as return of capital. So it lowers your basis. And then when you go to sell the fund, hopefully many, many years in the future, if ever, your basis will come down. So you'll have capital gains owed on the difference between your basis and the share price. But it's not a negative thing, especially if you're in a non-retirement account. So if you're in a brokerage account or in what we call a non-qualified account, it's actually a really nice tax advantage way to get income because you can generate or even spend that income off the fund and really not have, I think we were over 80% non-taxable based on the return of capital. So it's a really tax efficient way to generate income. The fund is still successful. It's just the way that the options contracts, the math is, it really turns out to be return of capital just straight. If you were selling a covered call, for example, the market went down and you got all the gain of that covered call, that more than likely would be taxable, but the spread structure does offset some of the gains and losses in the fund.
How will BLOX perform if the underlyings or if the market goes up, if it's flat, and if there is a downward movement in the market from both like a capital appreciation and a income standpoint?
So since inception, S&P is up about 12% total return. BLOX is up 20. And if I look at the standard deviation of the two, the BLOX has a higher standard deviation than say the S&P 500. This is where I think that we've actually seen where there's been some down days for the S&P where BLOX has been down in line with the S&P. And I think the reason for that is, one, crypto has somewhat acted as an inverse to the markets here recently. That hasn't always been the case. Bitcoin has been a risk-on asset generally, meaning if markets are doing well, if risk appetite is high, price of Bitcoin does better. If it's a risk-off environment and risk appetite is low, you see Bitcoin sell off. IBIT actually was up from March through the April tariff sell-off, where the S&P was down top to bottom 20%. I think it depends on what the circumstances are. If investors are fleeing to Bitcoin in a risk-off standpoint, then I think the fund can actually perform well through that. But if this is a risk-off environment and Bitcoin is selling off, just how we're kind of leveraged on the upside, we're not using leverage, but if Bitcoin sells off, if Bitcoin's down 2 to 3% in a day, I would think the fund would be down at least what Bitcoin is down, if not a little bit more. But we've actually seen days where Bitcoin's down 4 or 5% in a day, the fund may be down 2. So it's the equities and Bitcoin kind of offset each other. Last thing, not to get too technical, but as a reminder, we're selling call spreads on the Bitcoin and Ether side, selling puts on the equity side. Those two income pieces can actually offset each other. And so where if this side of the portfolio is going down, and this side's going down as well, but I'm still keeping the income from the call spreads. So generally, that's probably a long answer, but I would say in a risk-on environment, this fund should perform well. If we have volatility, I would just anticipate that this fund will probably perform worse than Bitcoin over the overall market. But if you're dollar cost averaging, or if you're looking for opportunities to put more money to work, I think this fund will give you ample opportunities throughout the year.
In terms of like a Bitcoin winter or a crypto winter, how should investors react to it? Because right now we're seeing Bitcoin do super well and BLOX is performing super well since launch, but investors haven't really experienced maybe a true Bitcoin or a crypto winter. So I want to know from your thoughts on how investors should react to it, whether they are a BLOX investor or just hold crypto or crypto related assets.
What I'm looking at is there have been 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. There have been 17 Bitcoin declines in the last 15 years of more than 30%. All of those have been met with pretty just nasty recoveries, nasty in a good way, right? And so what's encouraging for investors is every time Bitcoin has sold off, we have seen there's been a winter, but we've had a spring and a summer that has outperformed. So January of this year, January to April, Bitcoin was on 32%. It rallied 47%, took 120 days to get there, right? If you look at really some of the big ones, recent but big, 2018, Bitcoin lost 84% of its value. It rallied 500% over the next 3 years. Two things I'd say on that is it's a good question. We're going to have crypto winters. It's just part of the price of admission to own Bitcoin. Two things that we'll do on that. Obviously, when you're selling calls, Bitcoin price is going down. We get all the income from the calls that we're selling. So our Bitcoin sleeve should outperform, right? Because you figure if we can generate 4% a month on our Bitcoin spreads, that's annualized at 40 to 50% a year. If Bitcoin's declining 20, 30, 40%, depending on the path, but our options income might offset a lot of the decline on the Bitcoin sleeve. So you've got that piece there to act as a hedge. This is also why the active management matters. Beta is important. And even when we looked at the RSI on some of these names like Coinbase and Robinhood, I would say late July, there was probably a case that said, you know what, we could probably bring in more low beta names to the portfolio. We were still bullish on the sector as a whole. We did not make any low beta name changes, but that would be the solution on the equity sleeve is if we feel like we're going to be in a prolonged, meaning a quarter to two period where the crypto sector as a whole is going to underperform, we would reduce our beta exposure. So maybe instead of owning miners, we would own more of the chip makers. So own more of the companies that have a more diversified revenue stream that's not just based off crypto. So we have the ability to be nimble there, and we will absolutely make those changes.
How do you guys determine the equity weightings of that portfolio? Because the top holding is Robinhood, and then we got Galaxy Digital, Headache, Coinbase, etc., versus holdings that are in a lower weighted position in that portfolio. And can you also remind me on like how many holdings you guys expect to have on the equity side?
We've got about 12 positions right now on the equity side. We generally going to have anywhere between 10 to 15 positions on the equity sleeve. We try to keep them equal weighted, so somewhere between, on average, 4% of each position. Some of our positions, though, we will start with starter positions, mainly because of the volatility of the underlying, or this is the challenge with, unless you're getting in on IPO day, which, you know, as a fund manager, we have to be careful with that at times. But these stocks can move pretty quick. Like Circle, for example, we have a just under 2% weighting in Circle. That stock ran up. I mean, if you blinked, you missed it. It was up 80, 90% pretty quickly, 100%, I think, at one point. We waited for a pullback in a stock like that. We started with an initial position of 2%. Take Bitmine, for example. Bitmine ran up in price. We saw a nice, healthy pullback. So again, I'm a believer that I would love to think we're going to pick the bottom of a stock. I would love to think. The odds are we're just not. We did a starter position in Bitmine. We started at 2%. For example, we had a trigger to buy more at a certain price and it never hit. We got close. It was below $30 a share. We never hit it. It rallied up to over 55, I think, in the next week. So I hate that we missed it, but we'll be patient. Again, emotions don't drive this. I know it's easy to see these stocks move, but we'll be patient. If we don't get our trigger, we'll wait. My odds are we'll probably have another opportunity to put more to work. If the base case has changed and we don't feel that stock is going to come down to our certain price, we will raise that target and put money to work quicker than later. But on some of these names that are higher volatility, that have moved a lot, we're going to try to do the best that we can for shareholders and try to get the best price that we can, and not just do a 4% weighting just because that's what the rest of the stocks are. So, a name like Irene we're watching, we'll see, but we'd love to increase exposure into some of those names that have more upside.
This is not financial advice, but what are some tips you have for investors who want to achieve like the best results from investing in blocks?
Time horizon here is a big key, right? Like if you say, David, I'm buying a car next month and I want to make a quick buck. There's just too much volatility in the fund for I would say short-term moves like that. But if you're someone that, I would say if you want confidence in the income that you can spend with appreciation, because again, one of the things that I'm reminded with some of these income funds is you almost have to manage your spend. Meaning, okay, well, if an income fund is distributing 50%, my NAV may be going down as well. So I can't spend all the income. Again, I can't tell you based on your specific situation. A fund like BLOX, I think you could actually put a sizable amount in, confidently spend the distribution, and let the NAV and let the equities do the hard work of growing NAV over time. So to me, that's a big distinction of, do I want to spend confidently? And do I want to say, hey, if I've got whatever my portfolio is, 500,000, 10,000, a million, 2 million, I want to confidently spend this income, right? $1 million generates 30,000 a month of income. Would I feel confident putting my $1 million in a fund that I want the income, but I'm also going to, my million, maybe 800,000 or 700,000 in 6 months? Or can I put my money in a fund where I start with my million, whatever the number is, and it's just an easy round number, but I can take max income, but slowly, hopefully see that NAV increase over time. That's what we want with blocks. So I would say it's for those that want income, they want confident income, and they want to see, hopefully over time, their NAV increase.
I've noticed that on X and Blossom and Reddit that since the launch of blocks that investors have pretty much like fell in love with it. There's nothing bad that I've seen about blocks that people have said. They've added blocks as a complement to their portfolio, to other Bitcoin, to strategy, cover call ETFs, and even as a core position. So I want to know your thoughts on maybe why investors like blocks since it launched, because usually people are very skeptical or have a lot of bad things to say. But I know since launch, you guys are up in the green and the distributions and the whole performance says it all.
Yeah. So if you think about some of the leveraged funds that are out there, it's hard to make leveraged funds a core position in your portfolio. Maybe some people do it, but it's just really hard, right? Because if you have leverage on the upside, you're going to have it on the downside. I think blocks is a way that you can get leverage-like returns. I mean, we're already seeing it, right? 2x the returns of the S&P, 3x the returns of Bitcoin, where you can get leverage-like returns without the leverage decay that you might get by using futures or using options to provide that leverage. So to me, this actually can be a core asset. For some investors, is Bitcoin going to be a core asset? It might be. But for other investors, they may not feel comfortable having Bitcoin as their core asset. I love Bitcoin. I think there's big upside. But you may say, well, I don't want to have Bitcoin as my core asset. This blocks, I think, is a fund where you can have as a core asset, because it's not just Bitcoin. You truly have a diversified, publicly traded company. Again, real earnings, real revenue growth, real management that's trying to drive returns. So to me, it's broad-based, but you can have this as a pretty sizable sleeve if you're bullish on crypto as a whole and you want to get some income while you're getting growth.
What are your thoughts on dollar cost averaging? Because other funds that are cover call oriented with strategy and Bitcoin, they might see like the share price go down and down and down. And so they could just dollar cost average because they're getting a lower share price because of the NAV moving. But with blocks, I'm assuming that in a bull market for Bitcoin and Ethereum and all the underlying positions, that the share price will just only go up. So investors might not know how to like properly dollar cost average into this fund. But I'm going to throw it back to you on like your thoughts on dollar cost averaging into blocks.
So yeah, it's actually a really good question. If you're dollar cost averaging into a fund because the NAV is continuing to go down, to me, that is not a long-term success plan. But I know it makes us feel good if you have a fund that has a high distribution rate. Your only option generally is to dollar cost average back into that same fund. But if I'm dollar cost averaging into a fund that's continuing to decline in NAV and my dollar cost averaging isn't enough to offset what the NAV is declining, I'm just pouring money into what is a black hole. Because think about this. The only way that dollar cost averaging back into a fund works is if the income that you're generating is more than what the NAV is declining over time. If it's not, even though I'm getting a great high income, if I'm putting it back into a fund that the NAV is declining at a faster rate than the income that it's generating, there's no point in me putting more money into a fund like that. It feels better because we're programmed to think dollar cost averaging. There's probably a better name we could come up with than dollar cost averaging, or the opposite is I'm putting money back into a fund. I know it feels weird that I'm just buying at a higher price than maybe I did a couple weeks ago or a day ago. But when all I care about is more shares. I want more shares. I want more shares. I want more shares. But if I have more shares of a fund, even though it's gone up in value a little bit, if the distribution per share is going up at the same time as I'm buying back more shares, to me at the end of the day, that's what matters. And so I think it's a great point. You got to be okay with buying back in more at a higher price. But as long as the NAV is increasing and the per share price is going up, you're going to be rewarded. I would much rather have a dollar cost average back into a fund that's appreciating with the NAV versus a fund that the NAV is just not able to keep up with the distributions as I'm dollar cost averaging in.
What's one thing that you think investors or the media is getting wrong about blocks?
So I think the big thing that I see is the distribution rate. I know we spent some time just talking about this, but that's probably the one negative that we get. And so if you look on X, when you compare the distribution rate of blocks to a lot of other funds, it doesn't seem exciting, right? It really just doesn't. And I think that's where most people look first. Well, David, why would I invest in a 36% distribution rate fund when I can go get 60, 70, 80%? So again, I know this is like kind of the theme of this, but that's where I think would be where people maybe dismiss the fund right away. But I think it's when you really, the best thing to me, I know you've done this before, but I love to see when people compare, again, total return charts. It just tells the story, right? Give me a fund that is distributing income, that's not just a single stock or that's not just using leverage. Give me a diversified fund that has income, and let's go just line them up and let's just go total return and see where it all lays out. At the end of the day, all that matters is what that return is and what the value of your balance is. I don't care if I've gotten to that place by buying back more shares or if I've gotten to that place by my shares increasing. At the end of the day, it's the same thing. I just have more confidence as an investor if I'm putting more money to work in a fund that's increasing in value slowly over time.
What's one thing about blocks that investors are going to be talking about years from now?
I hope it's our wins, which if we go back to inception being June 17th, what if some of the underlying done? So if I just take Robinhood is up 45% since the inception of the fund, Ride is up 36%. NVIDIA is up 25%. Ride's up 37%. Hut's up 36%. XYZ is up 25%. Coin's up 22%. So there's been some names inside the portfolio that have really run up nicely. And for us, I hope we get remembered by our wins. Obviously, if there's a name in the portfolio that we think will underperform, we'll remove it pretty quickly. But I hope we can find a name in there that drives so much underlying performance that investors can really feel confident. But again, it's also interesting that we're equal weighting it. And so what I don't want to be is all in on one stock like MicroStrategy, for example. Very popular. It's very popular in the income fund place. But for me, it's harder to have a total return when you're diversified. If you said, hey, David, go all in on one stock, you might could do well, but you just take on so much additional risk by doing that. What Block's done is almost harder in that we are diversifying, going a broad-based approach, but we're hoping with that broad-based approach, it gives our investors confidence that if one of these names blows up, it's not going to impact the portfolio. But if one of them does really well, or a few of them do really well, it can hopefully drive total return for the fund.
What can investors expect of the future of X funds and the future of you managing blocks?
Yeah, so obviously we have lots of great ideas for funds in the future. There's so many great fund companies out there that come out with funds almost every day, right? And they're all unique and different. So for me, we don't want to waste investors' time. If I can't come up with a fund that's different than what's already out there or provide value, we're probably not going to put a fund out just to hopefully replicate something and steal some assets for another fund company. I'd love to put out something that drives real value and that can actually drive something that's not in the marketplace. That was the creation of blocks. There was nothing like blocks in the marketplace. There's still really not anything, in my opinion, like blocks in the marketplace. There's some other crypto income funds that are there, but they just are some of the same status quo, selling covered calls. So they're capping their upside exposure. They're not very active in the underlying. I think blocks was very unique. And so we want to do that with other weekly payers, with other income funds. We've got something in the works right now. I can't talk about it yet, but I think it's actually going to be really good. And I think investors are going to love it. So hopefully we'll be able to talk about that more in the coming months.
What are some non-financial advice? So what are some tips for investors who are beginners who want growth and income in this cover call space that is full of so many ETFs now? And I bet years from now, there'll be so many other ETFs as well.
At the end of the day, the underlying matters. And so I would say just be careful. Like, don't let the yield be the thing that allows you to choose a position. Because you have to remember, the structure of these funds, a high yield is a great thing, but a high yield is essentially the stock's implied volatility over the next X number of days. Implied volatility doesn't mean implied volatility up. It means implied volatility both up and down. So there's about as much as a chance that that stock will move up that percentage or down that percentage. So if I buy a fund that's an 80% distribution yield, has an 80% implied volatility, that stock could be down 80% over the next 12 months, or I forget, whatever the time data period set is for implied volatility. So keep that in mind, in that that's what the options market is pricing in, both up or down. So you really have to take that into consideration. I only want to put money to work in a fund that I believe in the story of the underlying. If there's a fund that's just grabbing the highest vol positions to try to distribute a high yield, that may or may not work out long term. And so you have to be very picky, in my opinion. Only buy the funds that you believe in the underlying and you believe that there's some upside story long term for those positions, because we want the income, but we ultimately want the growth of the underlying. There's nothing better. That's why take MicroStrategy. The funds that were based on MicroStrategy, like MSTY, there's a few other ones. Why did MSTY perform so well? It performed so well. The options managers did a great job. The underlying was heading up in value pretty significantly. That would have been a very different story if MicroStrategies underperformed over that time period. If you look at all these Misty, Palantir, Tesla at its peak when the stock's still doing fine, a lot of them were driven by underlying holdings, positions doing well. So that to me, like the underlying, and then what are the options managers doing and what's their story on generating income off of it?
Thank you so much, Mr. David Nicholas, the portfolio manager of BLOX as well as of X Funds. Now go ahead and check out BLOX, the Nicholas Crypto Income ETF. Now, if you guys like this video, please give it a like because this cute puppy did. And go ahead and check out our last interview right here on your screen. I love you guys so much. Crush it in the stock market and take it easy. Peace.